Good afternoon. I'm Greg Lau. I'm with RSR Partners. I'd like to welcome you to the latest in our Compensation Committee series titled Age of Alignment Part 2, Getting Strategy-Driven Performance Measurement Right. Our December webinar explored a fundamental question that was raised by the NACD Blue Ribbon Commission on Strategy Development. Does your committee's incentive structure reinforce or unintentionally undermine its chosen strategy? During that webinar, we discussed the alignment of business strategy and compensation, the role of the board, the hallmarks of a properly aligned program, and examples of various approaches to design, monitor, and revise the program. Today, we will build on that topic and take an in-depth look at how boards can implement the right performance measures to ensure a compensation program that will be an effective tool for driving and reinforcing corporate strategy. With Pearl Meyer and Partners Managing Director Matt Turner taking the lead, along with Michael Ning, who was with us in December, we will look at measurement selection and mix and practical concerns for measurement, goal setting, and the ongoing administration and governance of a winning program. Before we begin, let me turn it over to Ronell Perry with NACD's education team for a few housekeeping announcements. Ronell?
Great. Thank you, Greg. Live audience, if at any time during the presentation you would like to ask a question of our experts, please submit your questions and comments below. You can also click on one of the buttons below and access additional resources. Also, you may download the presentation today. Slides will also be available next week at pearlmeyer.com/Age of Alignment Part 2 Measurement. Also, you will automatically receive one skill-specific credit for your participation in today's webinar. Your credit may be applied to any NACD fellowship program, and you can contact the email address on the screen. Remember, slides will be available early next week at NACD Online and pearlmeyer.com. Greg, back to you.
Thank you, Ronell.
Okay.
Before we dive into the great and detailed measurement information Matt will outline in today's discussion, and Michael will provide us with a brief summary of the compensation and strategy discussion we had in December. Matt?
Thanks, Greg. Okay, good afternoon, folks. Today we're going to do a brief review of the key takeaways from the December webinar. My colleague Mike will handle those slides. Then we're going to get into the substance of the performance measures and goal setting that we'll cover today. We'll talk about identifying strategy-driven performance measures. Then we'll get into how we map those measures into the incentive plans in an effective way. Then we'll talk a bit about some practical concerns with performance measurement and making sure that they're working for you throughout the plan cycle. We will cover setting performance goals and some of the issues around that. And then we'll have time for some questions from the audience. So with that, let me turn it over to my colleague Mike, and he'll walk us through the key takeaways from December. Mike?
Great. Thanks, Matt. So moving on to the next slide here. Thanks again for joining us for Part 2 of the Age of Alignment series. Last time, in Part 1, my colleague Steve Van Putten and I talked about the importance of strategically aligned pay programs. We talked about the hallmarks of these programs. We discussed key analyses you can add to your governance toolbox, things like probability of achievement, value driver analysis, pay for performance analysis. And we also talked about the review, redact, repeat, and research cycle. If you missed Part 1, you can find a streaming version and slides on the NACD website, nacd.org, or at the Pearl Meyer website, pearlmeyer.com. The slide we're looking at now is from Part 1. It's a conceptual overview of how we see business and leadership strategy linking to compensation, or to the compensation decision process. We believe that competitive data, market prevalences, and the perspectives of shareholder advisory firms are important factors in determining pay. But a strategically aligned pay program should be driven by business and leadership strategy. Market practices, optics, etc. are also important, but they should inform pay programs. This process allows for the possible creation of designs that may differ from market norms, but are bespoke or tailored to your organization. So let's move to the next slide. Strategically aligned pay programs exhibit a number of hallmarks. They exhibit a balance of different perspectives. Looking to the right, we see driver and outcome metrics and alignment and accountability metrics. In most incentive plan designs, weight is shifted to the right side, outcome and accountability for results. Outcome metrics would include things like financial metrics, relative TSR, etc., while driver metrics include the strategic imperatives that drive future value creation. Things like market penetration, new products, new geographies, strategic alliances, etc. The second dynamic is the balance of alignment and accountability, the bottom triangle. Accountability is about tangible and defensible measurement, both relative and absolute. And alignment is about seeing the link between your role, or what you do, and the metrics that you're measured on. The third dynamic here is the how versus the what. Companies, for the most part, do a good job at measuring the what, things that are measurable or have easily determinable outcomes. But an important factor here is how results are attained, and that they can possibly be done using discretion. And we recognize that discretion can sometimes be challenging, but it can also be very helpful. And by discretion, it's meant both ways, up or down. When all is said and done, strategically aligned pay programs recognize that performance cannot be solely captured in a performance metric. Companies should use informed discretion as a way to determine incentive payouts. So that, in essence, is what was covered in part one. Today, we'll dig a little deeper into the how, into execution, moving from goals and strategy to operating decisions. So let me turn it over to my colleague, Matt Turner, and he will describe specifics.
Thanks, Mike. Okay, let's go to the next slide. So focusing on performance measures, they really are the critical link between a stated business strategy, an articulated business strategy, and management execution of that strategy. And the way we like to think about this is to gain some alignment between the overall goal and purpose of an organization and the tools and the way that managers make decisions within that organization. So we start with kind of the typical framework for a publicly traded company. The goal is to maximize shareholder value. And of course, there's some footnotes around this, but that is basically the end goal of a publicly traded company. Each company has a specific path to value creation, taking into account the market economics it faces, its competitive position, the strengths and weaknesses that it has, as well as the opportunities it faces and the risks it needs to deal with. So that's going to inform the strategy. Once you have a good idea of your strategy, it's important to understand what are the metrics that are going to help us understand how we're tracking against strategy execution. The first piece of that is identifying the centerpiece financial measures. These are the measures that help you balance off growth and returns to make sure that you are creating economic value as you move along through strategy execution. But where it really gets interesting is when you start thinking about what we refer to as driver measures. These are the measures that are very specific to your business strategy, tied to how you do business and how you execute your business strategy, and are going to be laced throughout all of the corporate processes in your organization. Incentive compensation is one of those processes. We think it's a very important one, but it's worth recognizing that there are other corporate processes that this framework is going to apply to. And the reason I mention that is because as we think about the kind of performance measures that are important for understanding how you're doing against business strategy, you want to remember that not every single measure that is going to be important for tracking strategy execution belongs in an incentive compensation program. But if it's an important measure, it ought to land somewhere in the corporate processes. And once we've got this alignment, we believe that ultimately you're going to improve the ability of your management team to make good, sound operating decisions and execute well against the business strategy. Next slide, please.
Matt, can I ask a question that's coming in from the audience?
Sure, Greg.
What links between pay metrics that you're discussing here and the balanced scorecards that board use do you recommend? The linkage between the pay metrics and the balanced scorecard.
I'm not sure I understand the question. What sort of linkage?
Right. Let's continue, and I'll go back to the question here.
Okay. Very good. Sorry about that. Okay. So taking a closer look at how we identify those measures, what we want to do is understand how a company creates value. And there are actually a lot of tools that we can bring to bear for understanding how measures are linked to value creation. This can be done through a host of statistical and economic analysis tools. And just to illustrate, what we have in the top left graphic illustrates correlation analysis, where we take a look at the relationship between financial measures and value creation across a peer group or a comparable group of companies. In the bottom left, what we see is a time series analysis between a couple of financial measures and stock price for a single company. Now, these tools are important, and they can help us understand the link between these financial measures and value, but we also want to be careful that we don't confuse correlation with causation. This will tell us you're on the right track, but of course we want to validate this by checking back with the business strategy and understanding if these are truly going to be linked to value creation. Deeper in the organization, when we think about all the measures, not just the financial measures, but the operational measures and the other driver measures, we want to go back directly to the business strategy. And remember, in December, we talked about this driver tree that's on it's on the right-hand side of the page. When you go below the financial measures, a well-constructed driver tree will help you identify and prioritize the kind of driver measures or lead measures that are best able to help you support your business strategy execution. And these measures should round out and populate your incentive compensation programs around the centerpiece financial measures. Next slide, please. So we have a case example here of what I'm talking about. This is a specialty chemicals manufacturer, and the company wishes to implement a long-term incentive plan that reinforces business strategy. They happen to be replacing a simple mix of stock options and restricted stock. Now, this particular company is focused on continued market growth and economically profitable returns by delivering manufacturing excellence and innovation. They're kind of at the higher end of their business in terms of what they offer up to their clients. They offer top-level, tailored customer service, and are very responsive to customer needs, especially around safety and quality. Now, this particular company wanted to have measures that traded off growth and returns, and as we looked at the market, we saw that return on net assets actually did a really nice job of explaining the creation of shareholder value, even more so than the cash return measure, return on gross assets, that we looked at versus their peer group. Well, here's the issue, though. The company knew it was facing a period of time when it had to invest at a much greater rate in its property, plant, and equipment, its manufacturing process, than it had in recent history. And it knew that as it made these investments, it was going to suppress the measured return on net assets as time went on. So linking back with business strategy, the company said, we've got a couple of different return measure perspectives we can choose from. We want to make sure we're choosing one that sends the right signal within our organization about where and when to invest and make sure we do not lose our edge in the marketplace. Okay, let's go to the next slide. So once you have your centerpiece financial measure or measures identified, you want to make sure you're balancing them appropriately based on your business strategy. A properly balanced performance measurement framework is going to emphasize profitable growth and returns, of course, consistent with the strategy and the market economics that you face. It's going to include as well a mix of other measures that ensure you have appropriate line of sight in the organization. Yes, it's important to increase returns and to grow the top line, but how specifically are we going to do that deep in the organization? That's where these line of sight measures come into play. You want to map these measures to the right incentive plans based on the time frame and the participant profile. For example, a return measure tends to do a better job of explaining value and communicating signals to a management team when it's part of a long-term incentive plan. Return measures can actually move around a bit from year to year, whereas other operational measures are going to do a better job in annual incentive plans. Finally, you want to think about who's responsible for what sort of decision making and where those measures belong in terms of an annual plan, a long-term plan, or a broad-based plan. Okay? Let's go to the next slide. Yes, Greg.
A couple questions here from the audience. How long should an LTIP performance period be? Is the norm still 3 years, or are some of them shorter or longer depending on what metrics you use?
The issue of the length of a long-term incentive plan is really a trade-off between the economics and the practical considerations that an organization may have. What we'd like to see in theory is that a long-term incentive plan, the time period that it applies to is matched up to the best way to explain value creation for the measures that are tied into the long-term incentive plan. If you think about some companies, that can be a pretty long cycle. It might be 5, 6, 7 years. But on the practical side, you want to make sure that the incentive plan provides good line of sight and has good optical value to the participants in the plan. And when you have an incentive plan that might stretch out beyond, say, 4 or 5 years, you start to lose some of that value, perception value in the minds of the participants. So we end up kind of gravitating back towards a 3-year plan because that period of time is just long enough to start to see some increased significance for some performance measures that you use, but not so long that you start to drop off in terms of the amount of value that participants perceive in the plan. And in fact, if we look in the marketplace, 3 years is the most common. Actually, the second most common still today is a 1-year plan, and then you see 4-year plans, 5-year plans, and 2-year plans as well. But 3 years tends to be the norm for a mix of economic and practical concerns.
One further question on the same chart, Matt, is that
yes.
on the TSR measures on the right-hand side, if the end game is absolute TSR, why is it weighted only 15% of total target pay?
Another great question, and this is really going to be a trade-off that every single company is going to need to tackle. How much of the incentive plan performance linkage is tied to the end result that you're looking for, and that is total shareholder return, either absolute and or relative or some balance, and how much is tied to the drivers or the path to creating that value in the first place. And it's a balance between alignment and line of sight. Clearly, if we want pure alignment, we could pay all of our executives based purely on absolute and relative TSR. But if we want line of sight, we want to be tied to the kind of measures that they know they can control and influence and their decisions directly impact. So the trade-off can be different for different companies. The 15% here might be a little bit misleading because they probably have some other form of equity compensation in the mix, perhaps stock options or even the use of plain old restricted stock. But it is a question that is worth asking, and we find that using a chart or a matrix like this really helps you think not only about the balance of financial and operational performance focus, but also the balance between those types of measures and the end game measures like total shareholder return.
Okay. Good.
Okay, so now let's go to the second case. This is a retail organization. We took a look at their incentive plans and discovered that they had 80% of the incentive plan performance measurement framework was tied to a couple of measures: sales growth or top line growth and gross margin dollars. Well, we took a closer look and discovered that those particular measures were highly redundant, both internal to the firm and among peers. In other words, if you're doing the kind of things that are going to move the needle on one measure, it is very likely that it's moving the other measure in a very proportionate way. So in fact, when we looked amongst their peers and we looked over time, we saw that there was very strong correlation between the two measures. What this did for the company is it opened their eyes that there was a little more room in the incentive plan performance measurement framework to fit some of the other driver measures into the equation. And so it allowed them to better balance the performance focus for their incentive plan participants so they can better execute a business strategy. Okay, the next slide. So looking a little bit deeper on the performance measures themselves, and in particular thinking about the centerpiece financial measures, sometimes it's worth considering the tailoring or moving off of GAAP definitions for your incentive plan performance measures. And I won't go down the entire list here. You'll have these slides and you can take a look at some of these considerations for each of these categories. What this slide is meant to do is illustrate where you want to put some thinking around whether or not you're going to tailor or change some of the definitions and calculation rules of your performance measures. You want to think about who the audience is or who the participants are in the plan and whether or not the element you're considering is relevant to their decision making. For example, actual versus standard tax rates. That tax rates might be, or the effective tax rate might be managed just by a couple or three people in an organization. Maybe you want to think about making sure that tax rates from year to year aren't driving the results as much as some of the more operational elements of your incentive plan. Non-cash charges, of course, you want to think about all of these. The effective exchange rates, and this is clearly a big topic today, you want to think about employee control and influence. And think about what your organization is doing with respect to the hedging of exchange rates or any other kind of exogenous factor control. Do you do financial hedging on a global basis, or do you have operational hedging throughout the organization? And you want to think about whatever your choice is going to be about what you do with exchange rates, you want to make sure that you're aware of how they might distort investment decisions. I won't go down the rest of this list, but I'll just leave it for your consideration that each of these things is worth thinking about.
Matt, do you think that compensation committees are using more discretion now on exchange rates in light of the strong dollar sort of impacting international operations?
You know, for the cycle ending with calendar year 2014, my experience is that it didn't rise to an unusually large item for consideration with adjustments at the end of the year. It's kind of been where it's been for a while. But I suspect if we look at what's happened over the start of the year here in the first couple of months, it may be a bigger issue for the cycle that ends with December 31, 2015. And what I would say is that it's actually going to be a bridge to one of our slides in the future, so hold off on further comment, but I do think it's going to be a bigger issue in 2015 than it was in 2014. And with that, let me turn it back in terms of the poll question.
Okay. Our first polling question, and should pop up. Ronell, can we see the question? So the question is, this past cycle in my company had adjustments to the incentive plan financial results, and A, all parties were comfortable with adjustments, B, members of the comp committee seemed to have reservations, C, members of the management team felt the results were unfair, D is both B and C, and E, we didn't have any adjustments to the financial results. So please mark your pick. So it's an interesting thing. Adjustments might be even more frequently in the last couple of years with a high variability of change. Do you see that, Matt or Mike?
I will tell you that I've seen this discussion get longer and deeper than it's been in the past. And I'm not sure if I can say that there's been more adjustments or less adjustments, but I do think that there's a deeper conversation going on around whether or not an adjustment is appropriate.
Well, and if it's a positive, it's somewhat welcomed by everybody. If it's negative, there are issues.
That's right. That's right.
Ronell, do we have the results yet?
There we are. Okay, so well, that's actually a decent sign here that almost half the folks that responded to this said there weren't any adjustments to the financial results. And I'm hoping that's for a lot of good reasons, and we'll talk about in a second here, but we do see that where there were adjustments, so the other half where there were some adjustments, a little more than half of those where there were adjustments, we saw that there was general comfort, and I'm hoping, again, that was for some good reasons. There are some cases where the comp committee members maybe had some reservations and some where management felt the results were unfair. And, of course, there was a case where nobody was happy, so I'd hate to be in that particular comp committee discussion. But let's talk about this on the next slide, which is slide 15. You pull that up, Ronell? Right. So thinking about the measures we were just talking about, you want to understand at the start of a cycle what are the limitations, what does it measure, what does it not measure, what does it not capture, and plan accordingly. So thinking about where there was some discomfort with the adjustments at the end of the cycle, my sense would be that perhaps the organization could have gone back a year prior and thought a little more about what might happen during the course of the year and how are we going to handle those situations if they pop up. You want to make sure that you've accounted for what you're going to do if you sell off some assets or you make some acquisitions or you divest of a business. You want to think about unusual swings in commodity prices, exchange rates, and interest rates. Settlement of lawsuits is a big one, too. That can really present some dilemmas, depending on how long the lawsuit has been pending. And certainly government-related items are a big issue, especially in insurance. Asset write-downs were a big issue 2 or 3 years ago. Share repurchases, hopefully the scheduled share repurchases have been taken into account, but there are some times when the financial structure of an organization changes in ways that you weren't necessarily expecting. Changes in accounting rules, windfall gains and losses, maybe you've lost a huge customer during the course of a year, or there's a bluebird business opportunity that really wasn't the result directly of any particular actions on the part of the team. You want to think about how you're going to handle those things. Now, whenever you think about adjustments, clearly you think about what have we done in the past around those particular situations, and that's really important. But I think you also want to consider the intent of the measures, the intent of that aspect of the incentive plan, as well as fairness, and external optics become important as well. Okay? Let's move to the next slide. We're going to shift gears a little bit to the goal-setting process. And the thing I'd like to note here is that the goal-setting process really is changing, and what we are seeing is that compensation committees are getting more involved than they've been in the past. More involved in terms of time and earlier involvement in the organization. Traditionally, what we've seen is that goal setting has been largely driven by the budget. It's been very much focused on setting of the target, and that the compensation committee gets involved at the end of the process in terms of approving ultimately the goals that are being recommended by the management team. What we think makes sense today is that instead of focusing primarily or solely on the budget process, that there really are multiple performance perspectives taken into account. That when we think about the goals that might be set, we've thought through the pay-to-performance scenarios in the future. So if we run out some business cases and we get certain results, are we comfortable with the calibration between pay and performance in those scenarios? And in fact, when we think about the compensation committee's involvement, it's early, it's active, and it might start as early as November in terms of thinking about the inputs to the goal-setting process. You want to think through questions like, what kind of level of performance justifies a target payout? What kind of incremental performance would justify a maximum payout, and how do we scale it to that? And when our fiscal year is completed and bonuses are paid, will we be comfortable communicating the results to shareholders? I guarantee you that is an important question for compensation committee members. Okay, next
Matt, speaking about the performance metrics, we have a question. Should asset impairment charges be excluded from earnings for incentive purposes?
I'll give the standard consultant answer on that. It depends. It depends on a lot of things. You want to think about what is the reason for the asset impairment in the first place. If it is something that is from a long historical event, or something that is totally divorced from management decision-making, or you have a new management team in place, then I think you're more likely going to exclude that from the calculation. You want to be careful how you exclude it, because you can actually create a windfall, especially around return measures, when you exclude it in certain ways. But if it in any way, shape, or form reflects decision-making or accountabilities of the management team, you might think twice about that and think about the overall impact of the decision, not just on a single incentive plan, but on all of the incentive plans, including the impact on the equity incentive plans, and think beyond a single year's impact as well. So circling right back to the answer, it depends. I think it's going to be very case-specific.
Okay. One other question regarding TSR. Is there any thought to having the measuring period end after the annual earnings release, as opposed to probably end of the calendar year?
I see. So I'm going to assume the question is presuming that TSR may jump a bit based on kind of an event of
Right.
the earnings announcement. And this has been discussed certainly among some of my clients and some of my partners' clients as well. Generally speaking, we feel like if we're looking at relative TSR, and most of the companies in a particular peer group or an index are going to be on a calendar year, or they're going to be on a quarter where the calendar doesn't match up with the ending of an earnings period, that it's kind of a wash. And so it always ends up being a bit easier to make the calculations based on a period of time that is common both to the company and to the rest of the peer group. When you start looking at earnings announcements, you get into questions about, well, are we capturing it just for ourselves versus some of our peers? And you end up with some real complexities around that.
Great, thanks.
Okay. All right, let's go to slide 17 then. So thinking about the goal setting process and the multiple perspectives, what I mean specifically is that you want to take into account both historical perspectives and forward-looking perspectives in setting of the company financial goals. We mentioned the budget setting process. That's clearly a part of this, but you also want to understand historical performance both for the company and for peers or comparables. And that might not be the peer group that you're using for benchmarking of compensation. You want to make sure you're talking about peers or comparables that are relevant for those particular measures that you're talking about. You also want to take a look at the bottom-up budgeting process and understand in a little more detail how are you getting to the numbers that you're getting. You also want to understand variance of results, and this gets at not just setting of the particular target for a measure, but what is the variance between threshold and maximum that's going to make sense for the organization. A lot of times you default to a plus or minus 10% or plus or minus 20%, but what we see sometimes when we look at measures is that the variance of potential results might be much narrower or much wider than you expect. And so don't be afraid to question that range of performance from threshold to maximum to make sure that you have a good, relevant, and robust performance range for your incentive plan. On the forward-looking side, you want to think about what's being expected of us. Clearly, there's a cost of capital perspective, and you want to think about the implications of your cost of capital return for delivery of results along the measures in your incentive plans. You also want to think about something we call shareholder expectations, and there are specific analyses you can do to understand what can we infer about our performance expectations from our current or prevailing share price or valuation. You also want to look at the multiple performance scenarios that I mentioned earlier and understand what kind of outcomes can we expect, what do they look like in terms of results and payouts, and as well as you can look at analyst estimates and what they're expecting in terms of your company's performance over the next few years. I think at this point we have another polling question, Greg.
We do. Question. My company's most recent exercise in financial goal setting, as explicitly reviewed by the Compensation Committee, made use of A, the company budget and long-range plan, B, analysis of company and peer group historical performance, C, cost of capital, required returns, and our required growth standards, D, forward-looking analysis, performance expectations, E is 2 or 3 of the above, and F is all of the above. So, Matt, Mike, what is your experience on this question?
Well, I'll say my experience on this is that companies tend to use 2 or 3 of these things, but that the company budget or long-range plan tends to be the primary driver. Where we get some deviation on this is where a company may be enjoying a lot of wind in their sails, or conversely, a company that's kind of in a bit of a workout situation or is concerned about affordability and value sharing related to their incentive plans. It's pretty rare still that we see companies going very deep and using all of the above as well as some of the other things I talked about on the prior page, but we're seeing more of it.
Yeah. Well, okay, Ronell, do we have the results? Oh, let's see. 2 and 3 of the above, as you were saying.
Yeah. So the single most prevalent practice amongst the single choices was the company budget and long-range plan. Not a surprise there. And I think it's encouraging to see about half are using multiple perspectives, and about a quarter are using an even broader set of perspectives. And that's a good sign. I'd say 23% is maybe even a little higher than my experience. So I think that's good that this is kind of on the minds of the folks on this webinar. and I suspect we'll see that number creep up in the future. So let's go to the next slide. And I've got another case that we'll go through, but before we get to that, I want to kind of run down a list here. I think we all like to have top 5 or top 10 lists. I've got some goal-setting pitfalls that I think it's important for companies to try to avoid. Number 1 is relying principally on the company budget or any single perspective. So we just saw that that's still the case for a number of companies, that they're relying principally or almost singularly on a single input. And I would say let's make sure that we can broaden that perspective. It's going to be very helpful to comp committees in the future. Number 2, presuming that financial performance relative to peers is as relevant or more relevant than stock price performance relative to peers. There's a lot behind this particular point, but the point I'd like to make here is that if you are consistently outperforming your peers in financial performance, but your total shareholder return is at or below the median of your peer group, what it's telling you is that the market is already expecting that you're going to outperform on the financial performance side for various reasons. It might be because they think you're the best management team in the world. But I think it's more likely because they expect there's some kind of economic rent or some kind of advantage that is built into your organization that allows them to expect that performance as a matter of course. The converse is true as well. 3, fixating on year-over-year performance or continuous improvement. I get concerned when you see a place where a company has performed extremely well for a year or two, and maybe the earnings growth has been 15, 20, 25% as opposed to maybe 5 or 10%, and there's a perspective on the compensation committee that, well, we still need to deliver 10% growth year over year. We don't want to build in any kind of implicit penalty on outperformance in a given year. So let's make sure we've got good context and we're thinking to the left and right of the goal-setting process and not get fixated on what last year's results imply in terms of growth year over year. Number 4, not doing a sanity check by modeling potential outcomes. This can be dangerous. You want to think about what happens if you perform at maximum on one plan, but you're below threshold on another, and gee whiz, it turns out that the focus from the outside is on the measures related to the plan that you were below threshold, but you're paying out maximum on another incentive plan. Do you feel comfortable with that result? As a compensation committee member, are you comfortable explaining that to external shareholders? And then number 5, becoming too anchored to past results or circumstances. This is the issue of getting focused on sunk costs in an organization. Maybe the organization has underperformed for a couple of years and you're looking for the organization to really make it up in the next year or so. That's likely not going to happen, and so you want to be realistic about how you set goals in an organization like that. The converse is true as well. I've had clients that have been incredibly fortunate and incredibly good at delivering the financial results year over year, and maybe have performed at 1.5 or 2 times target on their incentive plan year over year over year. You want to be careful that that doesn't anchor how you think about setting goals as your economics starts to change. So take those considerations into account and don't be too wedded to what you've seen in the past. Okay, we'll go to the next slide. So the target setting case, this is a natural resources company, and the company has consistently performed in the top quartile against its peers with respect to return on invested capital, as well as the contributing measures of ROIC, its earnings, its margins, and its asset turns. But it's been close to peer median on top line growth. When you think about relative TSR, it's been closer to median. So this is a little bit back on one of the pitfalls I was talking about earlier. There's a new performance share plan in place, and it's based on ROIC and sales growth over a 3-year period. The company plan, the internal company plan, foresees modest decline in ROIC and aggressive sales growth. So its ROIC is currently quite high versus both the peers and the cost of capital, and they expect it's going to decline a bit over the coming years. But it's actually going to reverse the position in terms of where the sales have been relative to peers and grow quite aggressively. Now, management initially believes the plan is worth something close to maximum because it's clearly superior to peers on the ROIC, even if ROIC is declining a bit, and it remains well above the cost of capital. So that combined with aggressive sales, management feels like this plan is worth something close to maximum. The compensation committee is concerned about the declining ROIC. So what happened, without getting too much into the sausage making, the shareholder expectations analysis that the company performed was consistent with the company's long-range plan. When you thought about building in a flat to declining ROIC pattern with a very aggressive sales growth pattern, you were able to explain the company's valuation today pretty well. And what happened, this led to a very valuable discussion in the Compensation Committee proceedings around the trade-offs between growth and returns. And ultimately, this company was comfortable trading off a bit of a decline in the ROIC for aggressive sales growth, as long as it remained above what the peers were doing, so it implied that there was an increase in market share. And the fact that the shareholder expectations analysis confirmed the plan numbers, it helped the Compensation Committee feel much more comfortable about the goals that were being set around this new performance share plan. So with that, let's go to the key takeaways for the presentation. So just a few points we'd like you to take away from this presentation. Performance measures can and ought to be explicitly linked to your business strategy and value creation, and we talked about some of the tools that can help you do that. Measures and the measurement framework should be tailored to each company's specific circumstances. Notice as we went through this presentation, we talked very, very little about market prevalence or what the peer companies were doing with respect to performance measures and goal setting. We really do believe this is a company-specific exercise, and that the measures and the framework should be tailored to the company's specific circumstances. The third point here, plan ahead. Avoid surprises with respect to how a measure is calculated and or what non-recurrent events are included in it. Let's avoid those surprises at the end of a cycle, and let's reduce the amount of adjustment that might be required for an incentive plan to make sure everybody's comfortable we're getting the right pay-to-performance relationship. And then finally, set goals based on a broad, robust set of analytic inputs, multiple perspectives. Let your Compensation Committee members get a good night's sleep. And I believe that if they're comfortable about the goals that are being set for the incentive plan, they're going to feel much more comfortable about the overall executive compensation program. And with that, I will turn it back to Ronell.
Matt.
Thank you, Greg.
Right. Ronell?
Great.
We have
Thank
a lot
you,
of
Matt.
questions, so I'll let Ronell talk about a couple, and then we'll come right back to the questions.
Great. Thanks, Greg. I'm excited that everyone was able to join us, and we would like you to join us again for another collaboration between NACD and Perlmeyer and Partners. Our next program in this compensation series is going to be the Age of Alignment Part 3, moving from theory to practice. You can register now. It's going to be live, same time, 2 p.m. Eastern Standard Time on May 14th, 2015. Please register at nacdonline.org/webinars. Also, for all of our NACD fellows, you can reach out to Megan Metzbauer, Senior Fellowships Program Manager, at the information on the screen if you have any questions about your fellowships. And please remember, you will automatically be awarded 1 skill credit for your participation in today's webinar. And Greg, I'm going to turn it back over to you for Q&A.
Thank you very much. Looking at our audience questions, Matt or Mike, can you give us an example of driver measures?
Sure. You know, Mike, I'm going to let you talk about that because I know you mentioned a couple of examples in the start with your intro slides, but why don't you give us an example of a few driver measures? I might have a few of my own as well.
Yeah, for sure. So we think of driver measures as those things that are linked to the strategic imperatives that drive future value creation for your company. And we think of these as separate as MISI from financial results. These would include things like entry into new markets, new geographies, mergers and acquisitions or strategic alliances, customer satisfaction, market penetration, things like that.
I do a lot of work with mutual insurance companies, and for better or for worse, mutual insurance companies do not have a share price that serves as an external, unbiased measure of value creation for the organization. And moreover, the way they measure value can't be reduced to a single financial metric as well. And they're kind of forced into thinking about driver measures on a bit of a larger scale even than public companies. And so what you find for them is more of their incentive plans are tied to them as well. And they'll look at things like customer satisfaction, quality of either product or service that's being delivered. They'll even look at things like employee engagement, because we know that there are some strong links between an engaged employee workforce and the kind of results that an organization can deliver in the future. The danger with driver measures, of course, if you're too balanced towards driver measures, is that there may sometimes be results delivered on driver measures that don't show up in the bottom line of an organization. So you want to make sure that you maintain a balance between the line of sight of driver measures and the alignment of things like the financial results and total shareholder return.
Very good. Next question. Should compensation committees adjust or review plans quarterly as opposed to waiting to the end of the year?
My view on this is that when you put a plan in place, you should let it run its course. But that being said, I think it's important throughout the course of the performance year or the performance cycle in the case of a multi-year plan that there are check-ins and that the management team is reporting to the compensation committee on progress as well as any issues or concerns around results throughout the course of the performance cycle. I do think on some rare occasions, and especially as we think about driver measures, there may be times when the context that a company is operating in might make moving the needle on a particular driver measure 180 degrees opposed to what you thought it was at the start of the year. And I think these periodic check-ins on performance and progress help for a very robust discussion with the compensation committee to understand whether or not they put a placeholder for some action at the end of the year, or if it's severe enough to, yes, think about adjusting how those measures impact incentives throughout the year.
Thank you. We mentioned a couple times in the presentation the measure ROIC. How predominant in use is that measure?
We looked at some data a few months ago from the top 200 large companies, and I believe ROIC and related measures like return on net assets tend to be about 15 to 20% prevalent in long-term incentive plans that are using financial measures. So they're fairly prevalent, and I'd say when you get below relative TSR, return measures in all categories are probably the most prevalent category of measures when compared to things like top-line growth or earnings growth or other measures like that. So they're fairly prevalent in long-term plans, a little less prevalent in short-term plans.
Very good. On our polling question on adjustments, did you mean routine adjustments to financial results or special items or discretion?
Well, what we really meant was not routine and not discretion, but something in between, which is to say there was a development. It has an impact on our financial result. We think that development may be appropriate to be excluded from the financial result for whatever particular reasons. So it's not something that is routine, but is something that is considered kind of ex post.
All right. How would you build
on that point, I guess, just to follow up on that, I guess what we'd like to see when we talk about the plan ahead is to move it from the ex post to the routine. So, for example, if you said, we've really had some issues with foreign exchange impact on our earnings results in each year, let's decide, folks, at the start of this cycle, what are we going to do about this? And you might say, well, let's just use the planned foreign exchange rate for this calculation, and that's going to be the calculation rule for our measure. Or you might say, as long as the foreign exchange rate, the actual rate from our planned rate, doesn't deviate by more than plus or minus 10%, we're going to let it float. And that's just part of the deal in terms of how we make the calculations. But if it goes outside that collar, then we're going to make the adjustment. I would say that has become a routine piece at that point as opposed to an ex post adjustment.
Okay, very good. Should all compensation metrics be quantitative? Is there room for qualitative assessments of management's performance?
That's a great question. I think that we all would like to use quantitative measures wherever we can. And ultimately, if everything was quantitative, I think we'd probably need to spend a little less time in compensation committee proceedings around executive compensation programs. But I think at the end of the day, when you consider the complexity and the time frame and the levers that are available to a senior management team, clearly there are some important financial measures that you need to pay attention to, but they just cannot tell the entire story of management performance. And so I think ultimately there's going to have to be some amount of non-quantitative or subjective performance measurement included in the framework. I just don't see a way around that for most companies.
Okay, agreed. How do you feel about using a survey of customer satisfaction as a metric to be used for compensation programs?
Well, I think it's a great idea, as long as you can overcome a few things. One is that you want to make sure that it is administered by an objective third party, or if it is done internally, that the compensation committee is going to be comfortable and confident that they're seeing the results in an objective way. The second is you want to make sure that you've got some level of confidence in the metric itself. There are some great companies out there doing customer satisfaction surveys, but depending on participation or who's included in the cross-section of cuts they use for your particular data, you can have the results jump around from year to year in ways that don't necessarily match up with your own company's intuition about the results. So customer satisfaction can be a great driver measure in some very specific industries. But as you use it practically, you want to make sure you're comfortable with how specifically you get that data and how it's incorporated into your incentive compensation programs.
That's a great comment, because you don't want to use the measure then end up forcing use of discretion.
That's right. Then you've got a double deviation from something that's quantitative and objective, and people start to get uncomfortable with that.
Right. How prevalent is the use of TSR for companies in the high technology sector?
Ooh, Mike, I might defer to you on that, because I think you do a little more work in the high-tech space. I know in general industry last year amongst large companies, we saw relative TSR finally tip over the 50% prevalence point. So it's not only the single most prevalent measure in long-term incentive plans, it's also in the majority of long-term incentive plans out there. But I'm not quite sure for high-tech. My suspicion is that it's probably at a lower level of prevalence. I don't know if you've seen any data recently on relative TSR in high-tech?
No, I think that sounds right, Matt. I defer to you on this, but that sounds right to me.
Yeah, it's been my experience in working with both compensation committees and executives in high-tech that there's a bit more distrust around a relative TSR measure, and I think it stems from the inherent volatility of share price amongst high-tech companies and their peers to start with. And so when you think about the relevant performance range for TSR, the traditional 25th to 75th percentile might not even be enough to make it feel like a right fit for high-tech companies. It has certainly been increasing, but I think it's been a lag in prevalence compared to non-high-tech companies.
Okay, another question. How would you build compensation variables around future performance needs in a context that initially involves substantial upfront investment in advance of revenue? So you're investing for future growth.
Yeah, well, I think the traditional answer here holds, and that is that you're going to emphasize equity. You're going to emphasize a long-term horizon for the executives and the management team that are involved with that organization. A lot of the heavy lifting we've been talking about throughout this program is going to be something you might need to put off until the future. I'll go back to the point I made about the pyramid, from goal to strategy to the centerpiece financial measures to driver measures and into the corporate processes. I think you're talking about a stage of life for an organization where less of those measures and driver measures flow into incentive compensation, but flow much more into the planning and resource allocation, the reporting function, the management quarterly reporting function, so that you're tracking progress along a lot of driver measures, even if they do not have a direct link into your current incentive compensation program. There's just going to be some practical concerns building those into incentives at that early stage of an organization's life.
Okay. We have one more minute, and I'm going to turn it back to Ronell. But I was just asking, in our strategy report, with all the variables and changes possible to the strategy, if during your LTI period the company formally changes strategy, what does the compensation committee do?
That's a great question as well. And you know, when we think about how often you would review the performance measurement framework, we typically say you want to review that whenever the company is making a meaningful shift in business strategy and or the market economics and competitive position of your company are changing in a way that's meaningful as well. So when you're talking about a multi-year incentive plan, it's much more likely that you're going to be in the middle of something like that than an annual incentive plan when you contemplate those kind of changes. Hopefully it's not going to happen that often, but there will be times when you want to stop, take a look at the in-process incentive plans, make sure they're at least not working against whatever your new or emergent business strategy is. Practically speaking, you're going to tend to want to let those things run their course, but make sure you get a new plan in place as quickly as possible for the next 3-year cycle. But there will be times when you're going to want to look at those in-process cycles and think about some adjustments if they're working against your new business strategy.
Excellent. Thank you, Matt and Mike from Pearl Meyer. Terrific conversation, terrific charts. Any questions that we did not answer, we will send the answers to the individuals. So we will follow up on that. We want to thank everybody for your participation in the webinar. We look forward to seeing you again in a couple months. And Ronell, I turn it back to you.